Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and today we're going to be talking about a major milestone that I just hit on my portfolio. If you do enjoy this type of content, make sure to subscribe to the channel. It helps me out a ton, and I do post weekly investing content. But with that being said, let's get right into it. So my newest milestone is that I've hit $10,000 in unrealized gains. It might not be a big deal to all of you, but for me, it is a very big deal. And I've been trying to chase down this $10,000 milestone for quite some time. If you have been keeping up with the channel, you would know that we have been inching closer and closer to it every single video, but finally we managed to do it, and that gives us a total return of over 34%, which is very good. Now, I do just want to clarify real quick that these are unrealized gains, meaning that I haven't yet sold any positions, so I haven't realized these gains. So in the coming weeks, if the price of my stocks does fluctuate, I could definitely see this either decrease or increase based on that. With valuations getting pretty high recently, I do think I'll see a decrease in my stock price, but only time will tell. As a reminder, this is not financial advice, and I'm just merely sharing my opinions on this channel. So the majority of my gains have come from the S&P 500. The broader market as a whole has been pushing upward pretty aggressively, but those gains within the S&P 500 have come from several individual stocks that have just increased like crazy, which we'll take a look at right after this. So year to date, the S&P 500 is up over 14%, sitting at 14.48%. In the past year, it's up 24.76%, which is absolutely crazy. Take a look at the 5 and 10-year performance. They're both pretty strong as well, with the 5-year performance being up 85.63% and the 10-year performance being up just as aggressively over 175%. And this does not include dividends being reinvested. Now, when you own an ETF like VOO, it does track the S&P 500, but what it does is it also pays you dividends from each of the 500 companies that pay out a dividend within the ETF. And so when you get those dividends and you reinvest them back to the company, it'll help accelerate and snowball your returns. Now, if we do want to look at the specific companies, we can take a look at Slick Charts. I like to use this company a lot to keep track of the performance within the S&P 500. And number one is still Super Microcomputers, down pretty significantly compared to what it was up originally at the start of this year once it had joined the S&P 500, but still up an outstanding 188%, and following that we have Nvidia at 149% return. Now, for the most part, Nvidia is the main company driving this stock price upwards. A 149% return is enough to push the entire market up very aggressively. On the other hand, taking a look at the bottom of this list, we can see some very big losses. Walgreens has been getting absolutely destroyed this year, and the same can be seen for Lululemon's. Athletic companies like Lululemon's and Nike have not had a good time so far. Also down here is a company which I own, and I posted a video on pretty recently where I bought more shares of Intel Corporation. If you want to check that out, I'll leave it pinned right here, and it's down 38% year to date. Now, I'm not sure if this is accounting for Friday's performance, but Nike is down over 30%, and I think dropped about 21% in one day after earnings were released. Taking a look back at my portfolio dashboard, we can see that in total I've invested $29,127, and this has not changed over the past couple of videos, mainly because I've been growing up this cash position, currently at around $4,767, and soon to be $5,767 once I load in my money for this month. Now, sooner or later, I do plan on investing that money. I don't want to just sit on it forever, but I was very low on capital for quite a while, so I wanted to build up this position once again and find good investments that I feel comfortable investing a lot of money into. I think right now a lot of the prices have been pretty elevated in the market, so I took a step back, but at some point I'm going to jump right back in, of course. The portfolio value is sitting at right under 40,000. I can't wait till we break that barrier. That will be very exciting, and we're getting closer and closer to that 50K mark. In total, I have earned $985 worth of dividend income, and my yearly projected income going forward is $703 per year. My current portfolio yield sits at 1.8%, and my yield based on the cost I paid for my shares is 2.41%. Taking a look down here, we can see this table which shows how much I've invested and how many dividends I've received each year since I started investing. In 2020, I invested just under $3,000. In 2021, I broke that $3,000 mark, but in 2022, it jumped significantly up to over $10,000 invested. 2023 was just shy of 10K, and of course in 2024, our goal is to invest 12K by the end of the year, so we'll have to see where we stack up by then. In terms of dividends, I did get paid $12.45 in 2020, $76 in 2021, and it basically over doubled in 2022 to $191, where it doubled again in 2023 to $459. Now this year, I don't think I'll see as significant of an increase in my dividend income compared to 2023, but it'll still be eclipsing it for sure. Taking a look right here, we can see that we're about halfway through the year, and we've already passed 2022's total dividend income for that year, and we're definitely past the halfway mark for 2023, so I can't wait to break that record. If you guys have been keeping up with the news, you may have seen that SCHD's dividend has increased by 20% from June of last year. Now, of course, they did rebalance the portfolio, so I think they put some higher yielding stocks in there, which is the main reason for that. But it's going to be great for my dividend income going forward, and it's definitely going to be a big month for me in July. Now, real quick, I do want to take a look at my pie section of my portfolio, and I have been getting a lot of questions down in the comments below on my spreadsheet and where people can access it. I did make the spreadsheet myself just to answer a couple of the questions, and I do want to make it available to my subscribers at some point. I just haven't gotten around to it, and I think I will make a version of the spreadsheet available at some point in the near future if there is enough interest. So if you guys are interested in the spreadsheet, definitely let me know down in the comments below so I can start gauging interest and seeing if it's worth putting it out there. Also, if you guys are enjoying the video so far, definitely leave a like. It helps me out a ton. I really appreciate it. So my pie just helps show different distributions of my portfolio. For example, I have 3 sections: key to success, that makes up 50% of my portfolio, divine dividends at 40%, and speculative at 10%. As well, I also have my cash position and portfolio position kind of laid out right here: 11% cash, 89% stocks, and I'm very happy with that right now. Clicking the slices button opens up my pie section, and you can see that VOO and SCHD are my 2 largest positions. At VOO, I have 36% of my portfolio, and SCHD makes about 12.1% of my portfolio, kind of balanced between growth and dividends, though they both do pay dividends, which I like to see. Now, the reason I own such a large position in VOO is for the most part, I want to be tracking the S&P 500. I would love to beat it just like any other investor, but I also want to be realistic and I don't want to be losing to the market by a lot. So this helps kind of guide my portfolio and its performance. Now in red here, we can see companies I'm thinking of cutting from my portfolio, and there's several different reasons for that, but I could definitely get into that in a future video. My divine dividend section includes companies that pay consistent and growing dividends and are very steady growers. So I have companies like Coca-Cola, Home Depot, Microsoft, S&P Global, and Northrop Grumman Corporation. Also cut out at the bottom here is United Health, which is one of my newer positions and a pretty large percentage of my portfolio. Now in the speculative section, we have either riskier stocks that are a little more speculative in nature, or just growth stocks which don't pay a dividend. Also some turnaround plays in here as well. So Google is in my speculative section. That's because it didn't used to pay a dividend. It is a blue chip company. I'm very confident in the company's performance, but since it didn't pay a dividend, I didn't want to put it obviously in the divine dividend section. But now that it is paying a dividend, it might be moved into there very soon, depending on if the dividend is going to be growing or if it's going to remain steady. Also, we do have a couple shares of Tesla here. The company is very volatile in nature, and that's why it makes its way into my speculative section. And even though it used to be one of my best performing companies, it has since had a very hard time climbing back up there. 3M recently cut their dividend, which definitely makes me not want to hold it as much. I haven't sold it just yet because I have not made the decision on what I'm going to do with it, but I do think going forward, I might be selling this position very soon. And now before we end this video, just to help you guys get a better idea of where my gains are coming from, I thought we would take a look at my best and worst performing companies within my portfolio. So starting off with the interesting ones, we have my best performing companies. I have Microsoft here. I bought 4 shares at some pretty good price, and because of that, I have a 95% gain on the position, which is absolutely fantastic. And of course, the only thing I wish is that I would have bought more. Now, my defense, at the time when I bought Microsoft, I was also buying Amazon, Google, and Apple. My portfolio value was significantly lower, so they made up a very big portion of my free cash flow that I had left to basically to invest into different companies. Now, had I had an opportunity like that now, I would be investing a lot more than I did back then, but I'm still happy with what I've done. I did $927 into Microsoft, $300 into Amazon, $571 to Google, and $1,232 into Apple. Now, as you can see, this has paid off for me very nicely. These are my 4 best performing positions, which I was very much hoping they would do. And I'm actually surprised at how much Google has actually grown in the past year to date. Then we have VOO, which, like I mentioned, is my foundation of my portfolio. It's the first thing I started investing in when I got into investing, and most of my portfolio is held into that one ETF. Since it is my oldest holding by far, we would expect it to have pretty good gains, and the reason it's not even higher than this is because I dollar cost averaged as it continued going up. If I only held my original position, it would be even higher than Apple in terms of total return. VOO also pays me nice dividends every single year. I've earned $451 of total dividend income, and going forward, I'm expected to earn $180 per year, plus or minus. Then surprisingly, we have General Dynamics in 6th place. It is up 41.18%, and it's a defense company, which is usually not the most aggressive growing company, but in the past year alone, it's actually grown 41%, which is amazing. I'm very happy about this position. On the other hand, we will take a look at Northrop Grumman, which is towards the bottom portfolio in just a little bit, and that one surprisingly has not done as well at all. And the last couple notable ones here are MasterCard and Visa, which I would expect them to perform well. I bought them at a very good valuation at the time. And then Tesla, which like I said, has been back and forth. At some point, it was my number 1 largest growing position, but now it's down here probably towards 8 or 9. And now just to wrap it up, we'll take a look at the bottom of my portfolio holdings. We can see that 3M is down over 10%, and this is including dividends reinvested. So had I not been reinvesting dividends this whole time, it would be down even more than that. So not great at all. The one thing I am happy about is because I only own 1 share of 3M. When they did split off, their Solventum, I believe, was the other company they split off into. I didn't have to buy any shares of that. They just gave me the cash for that instead, which I'm happy about because Solventum is not doing so well, I believe, since the split off. Then we have Northrop Grumman Corporation. So it's a very similar company to General Dynamics, a defense contractor. But I think at the time when I had purchased it, which is about the same time as General Dynamics, it was trading at a much higher valuation. And because of that, I haven't been able to enjoy any sort of returns within this company. As Chuck from Fastgraph says, valuation matters, and it matters a lot. And I could definitely agree. We also have PayPal down here, which I have bought as a turnaround play. It was significantly higher just a bit ago, but now it's down to 3% gains. It's been having a hard time recently getting beaten down by the stock market, and I do look forward to seeing how its next couple of quarters go when they release their earnings. And lastly, we do have United Health, and I do want to mention that even though this is a 6% gain, that's not necessarily a good thing. I certainly wouldn't say it's a bad thing, but a 6% gain is still pulling down my average, gain of 34%. Now, there are several reasons that this company has not increased so much, but a lot of it is because it is the most recent purchase of mine. I bought 5 shares at an average cost of $2,418 for the entire position, and the current value just sits just a little bit above that. I bought the stock as it was dipping down, and it has not recovered yet, which makes sense. If every stock just dipped down and shot back up, then everybody would just purchase every single dip. The nice thing about this position is I've already earned $18 off of dividends from it, and going forward I'm expecting to earn about $40 per year. So it's a pretty low yield relatively, but it's a very good dividend growth stock with very good history. Now, as always, that does bring us to the end of today's video. I really hope you guys enjoyed this deeper dive into my portfolio performance and what's been contributing to my gains that I've experienced this year. Make sure to let me know down below what your total return is sitting at. I would love to see how you guys are performing, especially with this market rally we have seen in the broader market. If you did enjoy this video and you want to see more of my content, it would mean a lot to me if you did subscribe to the channel. I would really appreciate it. If you haven't yet seen my latest video where I talk about my realty income position and how much I get paid from my 50 shares of realty income per month, check it out right here. And if you haven't seen my video talking about my dividend income from the month of May, check it out right here. Other than that, I want to thank you guys for watching, and I will see you in the next one.